Hello.
Okay. Yeah, this works.
Yeah, so I just sent you an obnoxious amount of questions. I put it through the form and I messaged you as well. You probably, you may have this in your presentation as well, but basically I just went through your entire YouTube like a proper stalker and pulled out anything that I thought would be valuable or was otherwise unclear. Um, so that I sent you a Google Doc for that if you want
Yeah,
to
I can pull that
check
up, or if you want to just read a few, I think it'd be more valuable for everyone if we kind of have it be a dynamic conversation instead of me just like withering about and whatever. But I can pull them off the Google Doc. But if there's a few that caught your eye initially, if you want to read them and kind of talk through your thought process a little more, I think we can have better communication when it's back and forth.
Absolutely. So,
Yeah.
yeah, I mean, just starting off with the most basic of all questions, when you're looking at the CAGR for a given portfolio, what would you say is your target number for that?
So I'm always looking in terms of risk adjusted returns because we can always kind of get more leverage per se. Um, but in terms of a CAGR, I'm really concerned with like how stable is that CAGR, and we're not looking at it on a one-off trade. So if you have something that trades every single day with 10 entries and you know your forward test matches your back test, I'm going to give a lot of weight to that. Whereas if you were to run like a 1 day fly that only happens when the VIX is up and we don't gap down 0.5%, and there's a couple pins that are like 5 times the average loss, it's like I'm much more skeptical of something like that. But when I'm looking at a portfolio, I think a really good spot to start to look at it is like the benefit of compounding, just like drawdowns, starts to get really good above 25%, above 33%. And then it kind of rips exponentially once you get to 33%. So I think a good spot, just from my basis on what's possible without excluding a bunch of entries and, you know, using data that's kind of parsed through on only certain experiences, like between that 33 and 50% return, I think is a really good spot to shoot for more experienced people. And then in addition to that, that should usually get you between like a back tested 5 or 6% drawdown, but back tests are always going to be way, larger, even if you've got the perfect back test. And when we go to drawdowns, like one thing I like to look at that I track in my portfolio a lot is like you look at average daily win, average daily loss, and like the volatility of your portfolio. And it's really not weird to have several strategies cluster, from here to there. So you're always going to get that drawdown. Like personally for me, I do filter out a little bit of the data in 2020 when the VIX was like above 40 because it's just so noisy, especially with stop loss. But excluding that period, I've never really made a portfolio where I didn't get basically to my drawdown within 90 days. You know what I'm saying? Obviously, I'm excluding some of that 2020 data, but from my experience with zero DT, that's basically what I've seen.
So you mentioned that one DT iron fly. That was another one of my questions. That trade specifically, because it's pretty interesting. So you often talk about the average that you're making per trade, for example. So let's say you put on one of those standard iron condors and you expect to make $28 per trade. Even if it's losing over time, it makes, let's say, $28 per trade. So that one DT iron fly, for example, it has that poor premium capture rate. It's at like 2.2%. But then it says you're making $89 per lot. The max drawdown is, let's say, 7%. This is a common iron,
Yeah.
1DT iron fly, so you know what I'm talking about. So you're saying that you're not interested in a trade like that, despite how much you're making per trade? Like, kind of how do you look at that? Especially given, so if you look at it since when the daily started, it's been, like an exponential on the exponential growth curve. So I'm
Yeah.
just kind of wondering about that.
Yeah. So the 1 day fly, I've spent quite a few time doing it. So this is one of the few trades where I'm kind of a believer that we're just looking at the SPX dailies data, mainly because if you just look at moves through days of the week before SPX dailies, that basically got excluded from all the good days of trading. So that one I'm potentially a little buyer, but I think that trade is pretty overstated and we need to look at it a little differently. And we need to always understand the shortcomings of it. So first of all, if you're trading a trade that only trades once a day and you're also using one DT data, which could deviate slightly, um, that's already kind of concerning with how accurate you're going to be to that. And another thing that I would recommend when people are testing that is like, you need to test that naked and you build in the cost of the wings on entry. So, if you're going 100 wide, like just kind of forget the wings, but like say you got 40 cents entry slippage or something, or even more than that, based on what you do, I recommend people go 0 DT wings. So when we're already looking at that, you could really screw up your back test because sure, when it pins, you make $5,000 and it's like this massive curve. But if your slippage is off, your average trade can go from making $70 in your back test to making like $20, which will drastically affect the compounded growth rate over that. And this is another thing that I have really learned and done stuff. It's like, it's great. Options Omega and automation and communities have allowed us to backtest so much, but a trade like that trades once a day and has 1 DT data, it's like the process of backtesting that is actually running it for 6, 9, 12 months to be very confident that your backtest is actually going to match. You don't like parse through the data and be like, this is good, I'm running it at 1% allocation sold per day in my portfolios. So I'm a believer in that trade. I think it's good. It's a nice diversifier of gamma exposure. So I really don't think that trade's necessarily better than trading 0 DT condors. But what I like most about that is if you eliminate slippage or you add in the same percent of slippage and you compare 0 DT ironflies or 0 DT condors at a larger lot with 1 DT ironflies, it shows that the 1 DT ironfly is clearly better. Will it match your back test or get your 7 MAR? No, I don't think that's going to happen, but that's enough confidence for me to run it. So I guess the question with that is like, we really need to think of how this works into our portfolio and how this works in our back test. And the main appeal of that is I'm very confident it's going to outperform 0 DT. And also we have very little unit risk trading something like that. So potential of stuff blowing up is not very scary. And it's really capital efficient for the premium you sell. I think it maybe gets 30% of the results of a lot of the back test I've seen out there. But even with that, it's a solid trade. And the nature of it, I've been trading it for a while, is you meander around break even for a quarter. And then 1 week you do like, 3% on your entire portfolio on a couple lots. So we also need to understand kind of the feeling of that trade. And you should basically be going naked or buying 0 DT wings when you trade it.
When you're looking at like a lower PCR or a lower MAR, do you reconcile? Do you consider that okay when you do have that higher amount per trade? I'm kind of trying to figure out like the interplay of your major metrics there.
Yeah. So I mean, PCR, I'm not as concerned with. The only dangerous part about PC, because if you're trading at the money structure, it's so capital efficient, you don't really need to think PCR, and so I'm not as concerned with that. But the dangerous part with low PCR trades is if you're off with your assumptions, and especially when you're at the money, you could easily be 40 cents off with stop loss slippage or entry slippage combined. And then all of a sudden you're going from a 2 PCR to 1 PCR, and that's going to make a dramatic difference. But I would actually recommend a lot of people look at what's the Kelly of that. You know what I'm saying? And that Kelly is going to kind of tell you, okay, if we eliminate capital requirements from this does look like it has a pretty good risk to reward what that is. But we have data risk because it's 1 DT. We have a lot of slippage risk because it's low premium capture. But and then also when I look at those too, so let's say I'm trading a put at 2 p.m. on like an EMA or something. Whoa, it looks great, 30% premium capture, and you're going for like $1.20 or something. But that $1.20, you may only have 10 cents of slippage tolerance if you're off on entry or exit. You know what I'm saying? And you're always going to be off on entry slippage because you don't get filled 5 cents off the mid exactly at 2 p.m. Whereas if you go with a $250 option or something where the win rate is slightly less and the PCR slightly less, you're just going to trust that data more. But that kind of goes back to just the process of backtest actually running it for 6, 9, 12 months until you're confident in what is doing it. But to answer your question, things I look at is like, I look at MAR because I think that's a good barometer for drawdown risk to reward. I look at Kelly, which is a good barometer of, ooh, can you size this? Do you have risk of doing it? I look at standard deviation because that's a good way to like remove any biases from the back test if you run that through some type of simulation. I look at Sortino because I don't want to be penalized to the upside, or if you're running a delta neutral trade that pins, I don't want to be penalized for that. And then I like to think of all the flaws of data risk, how much slippage tolerance could I have either way, up and down, to where this could start to become dangerous quite a bit. And a good way to think of it is it's like, if you're running a one lot and your standard deviation is, let's say, 10 basis points, and if your slippage is off 20 cents and your average return is, let's say, $120, you could potentially be adding 3 basis points of standard deviation if your slippage is off, which is like, that's a risk. And then if you're filtering out half the days because the VIX is up or down, like you should probably tack on even more, potential standard deviation flaws. So that's more of a way I like to think of it. Like, I know a lot of us run long straddle, like 1 day or 7 day. In that particular trade, the data is fire because we don't touch it basically. But the potential of standard deviation for that thing pinning or going back and forth, or even to the upside, is potentially huge. So, especially people that don't trade it as a long condor, like if I look at the back test, if you miss a few days during COVID or 2022 or the Fed day in 2024, that trade no longer looks very good. So that's a lot of execution risk. And I guess the theme is like everything's efficient. So if you have more data risk of, if you think it's accurate, you're probably going to take on a bunch of executional risks. Like your stop needs to hit at exactly a small slippage. Like you can't miss a day on a big winner when it's long ball or something. And the real solution to this is the whole, David Sun dragnet theory is you should have trades that don't have any mechanics and benefit super convexly that are long ball. You should have trades that trade super frequently with no filters and have a really low PCR and have executional risk or whatever it is. And you should have them spread out through the day. So I think we all got to the point that we like gamed our portfolios and saw good returns. And then we, built it on a spreadsheet. And now it's like, where are your flaws on how the market can move in your portfolio, And it's like, my portfolio, I run 18 strategies and they deviate a lot, but my standard deviation for the portfolio is like right on with what the back tested portfolio is, which I'm kind of fine with.
Okay. By the way, if anybody wants to interrupt, I keep looking at this for a raised hand. So yeah, I'm going to keep asking questions that are relevant to what you're saying until somebody raises a hand. But just following up on that, a big component, I put it in here a couple times, looking at risk in terms of premium or delta. Do you still see value in those delta-based trades, or are you focused on collecting that consistent credit?
So I like credit-based trades for 0DT because if the ball's 12 or it works in 40, it just didn't work in COVID 40. So I'm saying I'm walking away at that VIX handle, but that's going to be consistent throughout all time. However, the benefit of delta trades, if you're doing like you enter and there's a long delta trade with a short delta trade because you're taking the same notional risk, is I look at that as like we're getting the same slice of pie from a bigger pie when delta's higher because we're collecting more money at the same strike for the same probabilities. But where I often see people screw up is if we look at expected value formula, we have average win, average loss, win percentage, win loss equals our expected return. And when you use delta with a stop loss, you're really messing up the variables because you're not fixing your probability, because if the market moves quickly and you have a stop loss, you're not going to realize that probability. And then you're constantly messing with your average win size and your average loss size because your premium deviates. So I think going delta based is like really inefficient way to do that. But an example would be like if you're shorting a 0DT at the money, fly, and then you're using like a fixed loss of $10 or something. I think that makes the inputs of the expected value equation more stable. Granted, you are taking less risk when the market goes up, which also has problems, but I would say that's the best way to do it. And then definitely anything taking overnight, I'm always delta because the notional risk is too dangerous. But I do do delta trades, but they're basically exclusively shorting at the money, or it's offsetting the risk of a hedge in one. And the nice part about those is like our credit trades, boom, we're always going to, make 10 basis points a day over time. And then when vol gets really high, that same 1x notional can like really pick up steam to give you more better returns. And then that compounds faster if it wins, which feeds into you upping your credit trades faster. And if we look at the flaw with that, what I see is that we get the same Sharpe, but with sequence risk. So you're still going to get that 2 Sharpe of those delta based trades that are long short. However, you could have an 8% drawdown instead of a 5% drawdown. But if you're already sizing at that 5% drawdown, like I actually don't care that much about drawdowns, and I would tell people to not care about it either. What I care about is how much money did I spend to get out of drawdown. So like if you look at my spreadsheet, I get basically any drawdown below 1.5% costs no money to get back to even. And then 4.5% is like a 35 basis point return to get back to even. So I actually track how much do I have to get back to even instead of really my drawdown. Obviously, no, once we get to 10%, it starts to get really fishy. But if I can go a whole year with like paying less than 5% on volatility drag to get back to even, that's what actually I'm tracking, because I more look at the drawdown instead of the MAR as like how much money did we make from the benefit of compounding over time versus how much money we had to pay to get out of drawdown. And that's like kind of a weird MAR, but I think it is applicable for zero DTE people that think about it more in detail like that.
Mark, first of all, thanks for doing this. Very informative. So a couple of things. One is this delta versus premium base.
Yeah.
Should we be adjusting our back test when the volatility gets into a different regime if we were doing premium-based entries? Because the delta-based entries auto-adjust to your vol worlds, if volatility jumps into a different regime. But the premium, where our trades, our back tests are premium-based, are we being compensated for taking same amount of risk?
So yes and no. If you are continually buying 5-cent wings, I would not adjust it. So the problem I see when people credit target in high volatility environments is if you're credit targeting, let's say $3 and you're 100 wide and you only manage the short. So you're managing 295 at premium and you basically had 5 cents of entry slippage when we're doing it. But if you're in a higher VIX and you're still selling that $3, now you paid 20 cents for your wing, and now you're actually managing it with an 80% stop instead of a 1x stop. So in all the research I've done, from around the 7 delta to like the 20 delta, basically an option that's not going to get stopped out until, before it gets in the money, I have not seen any meaningful difference on basically win rate between those metrics across any volatility environment that's not the weird COVID time. However, the cost of wings definitely materially changes what you're doing. So how I've regimented my trades is I chose the premium target and went to the time of day that by choosing that premium target, when vol is really low, I'm getting stopped out before it goes in the money or when it basically touches. So we're always getting the benefit of theta. We don't have additional slippage and we're not trading much straddles. And then in high vol, it's still enough premium that if I have to go 200 wide or something, it's still worth it to me and I can afford to buy a nickel wing. So it will drastically affect your results if you're now paying 25% more for a wing, because if you're selling a $3 option, you just went from, we're essentially saying short vol is cheaper than long vol. So when vol gets higher and you think times are better, you're basically buying more of what you think is expensive. So that's what I recommend to people. But the delta based thing is like just short at the money. Like that should be one of your trades. You could do tight wings on it, whether it's a fixed like 30 wings, or you could manage with the stop loss. But that is the only trade in zero DT I think people should really do, is something at the money that's delta based, because that's the best way to scale vol. And then we already kind of talked about the flaws with doing that, where it's like you do use a fixed stop, which, messes the probabilities a little. But if we want to be as objective as possible, expected value equation, we have average win, average loss, and win rate. The only way when using delta, we can only have one variable flip up and down, is going to be by using a fixed lot with delta for that.
I've seen this discussion before too, where especially with like one DTE and the earn suite and different things like that, and the argument between delta targeting the triangle versus credit targeting it, and it was like if you credit target, you're further away, but you're not getting paid for the risk you're taking. Whereas like your delta targeting, you're getting the increased premium and you're getting paid for that risk that's now increased compared to in that low VIX environment.
Yeah, I mean, anything you're trading overnight, it's like, what's the one risk you don't like? Like limit down, the market rips, like the unknown of the unknown. And the only way to protect against that is units, which is the amount of contracts you sell. So, I mean, that is going to be a huge danger. And we also know, like, if we look at backtest, if you're trading 3 delta options, they get just as screwed as a 20 delta option when the market blows up, and they're a little more sensitive in other times as well. So I would say you got to look at what your risk is and what risk you're basically willing to accept. I know that David, which I like, and this is an example of how I think it was applied well, is like he trades 90-day out puts with stop losses, but then he uses credit targeting to be like, I'm going to sell however many units of this because he's like, my stop loss is my protection. But he realizes that his largest risk is a minus 20% gap down move. So he's always buying more units of like 2 delta options. So his stop loss is protecting him from any potential moves that occur. And then if the unknown of the unknown occurs, he has additional contracts that are long and short, which is the only thing that is basically guaranteed to protect you. So we need to think of what we're doing. Whereas in one DT, like if the market gaps down 5%, you're 300 points in the money. You just lost. You know what I'm saying? There's really no way around that. There's no mean reversion. So I would say people need to think about what risk they have and what risk they're taking. And if you're trading 90 or 120 days out, if the market goes down 5% or grinds down and the VIX doubles over 2 weeks, it's like you're going to be able to use your stop loss to get out on that because the Vega doesn't scale in that type of ration. So you can depend on your stop loss, but you need to kind of have that backup plan for what it is. And I'll even go back to zero DT. It's like with zero DT, I'm a believer that our stop losses will effectively always work. But if they don't work, my mindset is that means we've gone down past the long legs, 150 points instantaneously minimum, or we're at least hitting like a minus 7%. So if you have long straddles that you've run for 7 days, 14 days, or 1 day, like those are going to start making a significant amount of money once it gaps past your long legs. So we have to think about the risk and such that we're taking. Whereas the way I view zero DT, it's like if it gaps and we get some massive stop loss, it's like, I think that has to be some crazy move if that fails. So that's the assumption that I've taken. But in normal times, our stop loss will just protect us minus a little bit of additional slippage.
Kirk, Mr. Anderson, how you guys doing?
Good.
Awesome. Thank you guys for putting this on. Mark, I just had a question. I may have asked you this before, and I joined a little late, so apologize if you guys already covered it. But I've been doing a lot of the 7-day DT earn trades.
I like the trade.
Yeah, it's like super high win rate. Like obviously, it's not been performing well for this year, the first quarter so far, with all of the volatility. But I found that I like to when I'm doing the stops. So I'm in IBKR and I'm using the relative conditional order, and I'm just putting it on the short leg. But what happened in one of my trades was, so the market rips down, I'm just putting the stop on the short, it gets stopped out, but then the long is left, right? And then if you don't close out the long, market goes back the other way, and now you're kind of like double whammied, or you got hit on the recovery. So I'm just wondering, like, how do you place your stop just on the short? Do you try to do you put your stop on both legs and then eat the extra slippage? Like, what's your thought on?
Yeah. So my opinion with that is like, so if we're in a movie theater and there's a fire and you need to get out, everyone runs to the door. So if I'm in a movie theater and it's just me, I think I have a pretty good chance to run out the door. But if I'm in the movie theater and I have, my wife and 3 kids, we're going to have a hell of a time getting out of the movie theater together. So I think that you should always manage the short. And the only time I see people looking to manage the vertical leg is when they want to go tighter to take on more leverage. And, I think most people have learned this. It wasn't necessarily applicable in 2022, but it's been that. It's like there's really not enough edge to give up another 10 cents of slippage to man an extra leg and to pay 35 cents or 20% of your premium to do the long leg. Because if we want to talk about what we're doing is if you sell a $2 option and you buy a 40-cent wing, it's like you're giving the broker, like you're giving the market maker 5% of your premium for crossing the bid-ask spread. Then you're giving the exchange 3% of your premium to execute the trade. And then you're buying a long leg to basically rent leverage from the broker for another 25% of your trade. So if we look at it from a business perspective, we can clearly see that's an inefficient way to exert our opinion. And like the premium capture almost goes down dollar for dollar with the more you pay for your long leg. If you've ever looked at back test of trading 0DT naked, the premium capture is good on like everything, so I would say that, but a lot of softwares, I know like Trade Steward does it, I think TAT does it now, is you can sell back your long leg into the market. So you can almost say you're renting it. So I would say the most responsible way to do it is be like, I'm always going to buy a 15-cent leg and you're going to factor that into your cost. And I'm always going to sell it back to the market after I get stopped. And to match your 1x stop, you'll put your stop at like 1 at 1.15, or, you do the math on your spreadsheet, whether you're 2x stop. And I think that is by far the best way to do it. Or if you honestly do a back test, they do go in the money eventually. So if you're buying like 15, if you're buying 15-cent options, they go in the money about twice a year, depending on the time. And that's just holding it to expiration. So it's all fine. It's just what the payoff do you want? And like personally for me, I would rather just take the small loss every day of 5 cents than get bailed out once in a while for a super lotto. But this comes back into your opinion where it's like I hold 1x long straddle always in my account with no wings. So if we go down, sure, I may not have 40 loss, the one day when it goes down 7%, but every day it goes down 1.5%, I get paid. And that's got like a 40% win rate on long straddles. So I'm much more confident in the results of that. Because even like, I know we've all traded, but if you try and back test it, it's hard to determine what's actually the 10 or 15 cent option and then it's like, do you work slippage into it? So that back test, I don't have much confidence in it. One thing I will say, if your super lottos ever do start to go in the money, just let them run.
Yeah, that was going to be my follow-up question is like, what do you do? Like, what do you do?
Expiration.
With the loans, right?
Expiration. Yeah.
Awesome. Thank you.
Mark, I'd like to ask you a little bit more about those long straddles. So I'm wondering, do you diversify with 1, 3, 7, 14 DT? And are you running anything in the VIX complex? How are you kind of looking at those currently?
So I do 1, 7, and 14. From looking at the back test, like they're going to cover all of the durations because they just walk down day by day. You know what I'm saying? You could get 90% of that benefit with one day. I'd think with what you're doing. And then the VIX complex, like that is for not getting margin called. That's what VIX are for, because you can't really liquidate it at that price. It's a weird instrument. You have to take kind of like a lot of leverage on and what that goes. So it's like if you're trying to offset naked options from when the VIX goes to some astronomical level to call out margin calls, that's what the VIX is really good for, because it's hard to liquidate. Whereas the best hedge, in my opinion, and I got this from Chris Seidel and I've seen it too, is if you something that's not volatile at all. Like I can't really think of an example off of my head, but like SHY or something, like the 1 to 3 year rate, if you buy, let's say, 4-cent options that are at like the 10 delta, granted it's got a lot of commission costs or whatever, if we hit a 60 VIX handle, like those things are going to mark at 16 cents and you're going to have no problem executing it just because volatility is completely repriced across absolutely everything. And that is a much better way than using some type of, I mean, I think institutions with crazy execution that know more about vol could do from that. But the reason I love the straddle is because like it's in the money. We're not arguing about what that intrinsic is. And regardless of where liquidity is and what my shorts are marking at that I'm trying to protect from, I know intrinsically what my risk is. So if you're quoting me a, $30 wide bid ask spread, I'm just going to hold the option until that basically reconciles. And I kind of got this from Special K too, is like, there's no perfect hedge in a like down scenario, and anything can occur. But one thing I do know for sure is that the monetization of a straddle is extremely straightforward. And I can tell you exactly how that protects my risk. And the bonus is if you're in IB, you're going to get margin offset for it. So you can buy that 5-cent wing on a lot of your options, and you're only going to use the buying power of like a 20-cent wide wing, a $20 wide wing, because the straddle is going to offset it. So that helps you, use 80% of your buying power while your broker never said you use more than 40 per se. So I just feel the most confident in long straddle over all of that. And then I do think that holding just long units of S&P is good, which would be like 90-day out, 2 delta puts, to basically have that. And an example in hedging that I'll give for that is like if you back test a $1 90-day out put, it has like a 200% premium capture with like let's call it $1,000 profit take. But if you test a 2 delta 90-day output, it basically always loses money but wins on the same days that the other ones does. So that's just an example of you clearly are not able to liquidate that at the 932 peak of what's marking with that $1 one, or you would be able to do it at the 2 delta because that's the only one that's accurately priced and actually has a bid on it. Because another thing too, if we go from the market making perspective, it's like each strike has an implied volatility, and that's the only variable market makers are allowed to change based on the aggregate demand of the market. So that $1 option, when it spikes, it's just a function of market makers saying, hey, liquidity, we're going to make up 1,000 handle on the implied volatility at the strike. Whereas that 2 delta, it's like there's probably actually a price on that rather than 1 delta, there's 50 in the chain that are all priced at $1.90, So I would say like what's tactical, and anything when we start to get below 20% or anything that doesn't work like delta based for that same premium is where I say, ooh, too hard. I don't want a protection that may not protect me. Similar to holding VIX of 80, Because if we saw August 5th, I remember seeing the print pre-market at 65, and literally before 932, it was at like 40. So that kind of gives perspective of, what that is. And I don't know that much about option slope, but I don't think that market makers looking to get rid of that VIX call at 80 when stuff's going like that. So they'd probably make you pay to cross that bid ask.
Great. Thank you.
Some of your questions, Mastro.
I mean, I got infinite. I just don't want to monopolize, so I'm just like waiting for somebody else to pop in before I move on.
Yeah, I know you've been putting in work doing your research between Mark's YouTube channel and Option Omega.
You don't get many opportunities to talk to somebody who's done what Mark has done, so you got to take advantage of it.
Mark, can I ask you something else? I asked you yesterday in David's Discord about liquidity.
Yeah.
It's always something, it's a bit confusing for me. So if you can explain a little bit, what's the difference between the usual market liquidity and then on the expiration date liquidity, what's going on?
So I've been kind of playing with this in my head where it's like you hear stuff from fancy University of Chicago option people, but I think 0DT, it's like the concepts exist, but there's kind of new rules. So the way to think of it is SPX is the biggest option taker, half of all volume is 0DT options on the day of expiration. And then so basically on any given day, half of all of the world's options are SPX effectively. So I really don't think liquidity in terms of do we have an accurate price, as long as you're going off of bid, is really ever going to be a problem in 0DT unless we're at some crazy minus 5% limit down type scenario. And also from things I've read as well is liquidity actually gets better when the market is in turmoil, especially on the put side, because there's more of a demand for it and there's more price discovery going on. But in general, I don't know if you had more specific on that question. I'm not personally worried about it. I wouldn't be, 10% of the open interest at a strike or something. I think you'd have a lot of problems with something like that. But in terms of all of us just trading tranches here and there, in aggregate, the slippage has always been accurate and good for me. I do have days when I get 3 times my stop loss on crazy moves and whatever, but there was only one day last year where the move wasn't big and we got bad slippage. Other than that, they've all been massive moves. Even last Friday, it wasn't bad. I think I got $2 or $3 slippage when the market blew up, but that was an 8-point gap. So, I'm completely happy with what that is. I do think if you're running longer dated stuff or calendars when you're shopping 4 or 5 legs, it could get problematic. But yeah, I'm really not very concerned. I've even gotten stopped out in the last 10 minutes and I'm pretty impressed with my fills at that point also. I know some people look at volume bands and whatever. I met some guy on LinkedIn that runs an algorithmic futures hedge fund, and they can kind of identify areas where market makers have kind of reached their tolerance of, picking any, they're going to start picking direction, and then they go off of that. So I do buy that there's parties out there that are looking at that and inadvertently benefit off of our trading. But that's always been the nature of the market. The way you need to think of it is there's high frequency trading people that are transacting in prices that we aren't even aware of and are jumping in front of our brokers and market makers to execute it. Then there's the systematic guys like us that come in next that are always doing defined schedules and selling some type of edge. And then there's I wouldn't call them discretionary, but they're looking at signals of volumes and whatever, more advanced. Some people do it that run discords and just look at candles or volumes on toss. I would say the majority of them are more advanced. So that's kind of always the order of liquidity. And one thing I do know, you have to ask Turtle to get more specific because he worked for a high frequency market making firm. But if you put in your order for something you tranched at 10.15 for $2 on a bid or something to buy it back, and then 3 hours later someone puts in that same order, you're in front of them in the book. So if you're putting a broker resting or exchange resting stop, there's lines for that price. They don't just say, oh, hey, who's going in to get this? You came in 4 hours ago and put that order. You came in 2 hours. It doesn't matter. We just picked one out of the hat. So that also is kind of how liquidity plays and why I think we may do a little better. Whereas if you're trying to catch a falling knife and you're trading, a 300 lot contract, I could see that you could potentially get in trouble with the stop loss in a situation like that. But for us, in the way we trade is systematic, and we're less than 1% of the bid-ask spread significantly, I don't think we have too much trouble with it. But someone else that's more in the option space would know more.
Would you say the higher delta, the more liquid they would be?
Anything above 5 delta is pretty liquid, in my opinion. I would say that I'm more worried about trading any delta that starts to go on the money because that gamma picks up. It's efficient. So if you're really far out of the money, the market makers are quoting weird volatility that's not actually relevant. And then if you're in the money when the market goes down by $4, that jump risk is guaranteed to get you automatically. So what I like to tell people is 7 to 25 delta. I haven't seen much difference with a fixed stop on what that looks like. I do think there is an inflection point. So if you're below 70 cents of collecting premium, or you're, above, let's say $8 or $10, or you're at the money, the benefit of like your slippage outside of those ranges starts to take up much more cost of what that is. Like I trade at the money stuff. My normal slippage, like I'll get perfect fills when the market's not moving, but when the market moves, it's very normal for me to get $120 of slippage. Granted, as a percent of my premium I sold, that's maybe only, 1 or 2%. So it's not a big deal. But I would say like the best way to think of it is like there's a curve and it flattens out on the top end of premium and on the bottom end of premium. And you can tell from your test like where that is. And I would recommend that people participate along that entire curve. Or if you say, ooh, it looks like it starts to drop off at $5, like use the $4 option because you have $1 of wiggle room if any market environments change to where you should be more consistent with what that is. But it ultimately comes back as what a lot of people get wrong with back testing is I used to think like that is getting a systematic portfolio that you're really confident in comes from 12 months to 18 months of actually trading it and actually tracking it and actually seeing what that is. And like, knowing what those expectations are through different regimes. It's not just I've made it on option no mega, let's hit it,
Thank you.
Yeah, and I want to add one more thing on the topic of liquidity. Yesterday, I was talking to SIBO about some other things, and I had put out that AI generated podcast where they put out like 56% record high or something, 56% of it. And then yesterday he said that they had 3.3 to 3.5 million contracts traded at noon. It was about 12:30 yesterday.
Yeah. Another thing too is I don't know a huge amount about the underworkings of the market, but if you look at it, it's like our broker's not necessarily getting rich off of us trading 0DT from their commissions. They, if we make money, they obviously make interest float and we sell more contracts. So that's helpful. It's like, I actually don't think the market makers are necessarily getting extremely rich. I just did see an article on LinkedIn that like Citadel set a new record for money they made with their market making activities, but it's like the party that's really making money is the SIBO. So I'm pretty entrusting that the SIBO is trying to make it easier for the market makers to execute our stop losses. And they're trying to make it easier for the market makers to, balance their exposure of what that is. Cause this is such a cash cow for them. It's like, think about it, 3 million contracts. If you trade over 300 contracts a day, you're paying, 75 cents because you're a professional, which is probably the majority of the contracts in SPX. So they're pulling in, $2.5 million to $3 yesterday just on an exchange fee. And like everyone's paying that unless you have an exchange license, which are the market makers. So I do think that it's balanced out that we do everything. One thing I will say is anything with a single point of failure will eventually fail. And that's the definition of the SIBO. So pulling money out and not having more than like 50% of your money in options, I think is very prudent advice as well.
So you say that one more time. I think you cut out.
I would say that like the SIBO, anything with a single point of failure will eventually fail. And the SIBO and options are the literal definition of that. So I do think eventually there will be a large problem with something that occurs. However, I think this is like a 10 to 20 year time frame on when that happens. And even if it does blow up, I think it's more marginal than boom, 20%, you know what I'm saying? But I would say that like, I would not recommend having more than 50% of your money in trading options. And I think working up to 25% is a good starting point for a goal for people to look at. Because diversification really is the free lunch with what that is. And then maybe on some of your contracts, like keep the long options legs. So again, you're accepting more risk and you've got more ways to offset that risk if it gets extreme.
So I saw that for your technical indicators, you really only use the EMA 20 and 40. Are you still restricting your technical filters to those?
I mean, my thing with that is I'll say like what I release on YouTube is not what I trade in the fund because I'm more catering towards like what can people run with whatever software and stuff is available there. But my kind of view on that is we're always trend following and using some type of indicator because we're using a stop loss. So if you're pulling off your trade, you're saying that the trend will continue to go in that direction, or if you're in. So I don't have a problem with using trend. I actually think most people should. I'm actually pretty into dual momentum. If you heard it with Gary Antonisi, and it's like there's data going back to 9th century rice prices in Japan that humans are greedy and fearful, and that trend will basically continue to go. So the way I look at it is, at best, indicators that you have that can consistent, like indicators that you have that's like you go long or you go short or you sell put or you go call, like at max increase your win rate by like 2%, which is a big difference over time, but they're not like these crazy material things. Because when we're selling options at the core, I'm thinking that we are selling risk premium and there's just inherent edge in the quoted price. So a lot more of the benefit is how do you protect against the drawdown and get more compounding, versus just, oh, how do I maximize my ability to have some curve fitted thing? Because like if you look at it on any test I've done, and I've gone through the experience of trying to find the best test, and it's like the more things I exclude, or the more things when I only take one side and not the other, like the market just changes too fast and it eventually, becomes different over a period of time. Like I saw an options Omega trade the other day when they're like, the VIX goes up 20%. We want to get out at a 10% profit take. And then it's just like, yeah, since SPX dailies, it didn't keep going down, but that wasn't the case in 2008. You're just dealing with such a sparse data set that you're using options Omega to justify your discretion. That's basically what you're doing. So it's not really my style. I do think it can provide insights of what you're doing, but you need to be aware of it. Or I know a lot of people will trade an 80% stop instead of a 1x stop on MEIC or something, so they don't have to lose. But if you look at it, like you have less premium capture, and that benefit in MAR is just completely dependent on that your slippage will never be more, and what that is. Like the way I look at it, it's like whether you have an 80% stop or a 1x stop, you're managing the short at 1.1 or the short at 80. It's like you're all going to get around 4 or 5% premium capture. The route there could be slightly different, but when you're not compounding at 100%, the difference in that drawdown is not going to be as material as you think.
Got it. So what are you running every day? So like a trade that doesn't have any filters, is it just that entry, the standard lower premium condor, where you're just entering at every 2 minutes or whatever?
Yeah. And I mean, I kind of like those trades because I just call them the dumb trade. It's like VIX up doesn't work, VIX down doesn't work, market up certain percent, like nothing really affects it. I mean, I have that buying power. I have the long hedges on to where it goes. And I really don't expect those to yield. Like if I'm getting 5% on those, that's like great. But with the caveat to that is, the stock market makes money over time. So, that doesn't mean you should just leverage your account to trade like 50% of your buying power. But if you're not trading it, it's like, why are you not selling 50 basis points in condors every 15 minutes if your account warrants it? It's like, it will make money over time. It's not super lucrative, but it's capital efficient. So we should do it. So I'm always offlaying that. I always have long straddles. I have multiple types of trend overlaying. Like a problem with EMA is it's very basic and it's not really applicable to volatility. And since we're trading options, it's like a price signal is a lot more noisy when it comes to selling premium. So I'll have some indicators that are based on option price. That's a little harder for people to automate. But in general, like all the cores, the trend, which is the behavioral edge that people are greedy and fearful, and that continues to go, and that options have risk premium and decay and expiration. So I'm not really trying to game those that much. I'm more just saying, okay, how do we protect against the risk? And if we can get 2 or 3 more percent, what that is. And the concept I think people really miss out a lot. And it's like, if you have a 1 sharp with a trade that can trade 5 times a day, every day during the year, that'll actually be like a 5 sharp. But if you have a trade that's 5 sharp that only trades Fridays when the VIX opens up between 2 and 215 on an opening range breakout with a 12 sharp, it's like you don't get to use it that much. And if you miss like 1 entry or 1 big win, like all of a sudden you don't have it at all. So that's like a mathematical challenge that I would give to a lot of people during their testing, is the route to have a modest sharp on a price that you can accurately execute and you can mash the probability button a lot is extremely valuable over a period of time.
Mark.
Okay.
Yeah.
Go ahead, Vijay.
Yeah. On calendars. So a lot of chatter on.
I've given up.
Calendar.
I've given up. I'm no longer a believer in short dated calendars. I didn't think I'd say it, but yeah. I've given up.
I've been doing the Friday 6-7. I'm doing the 2-3s on Monday, Tuesday, but like I totally agree. Like it's spotty at best and like not consistent. But I'm just like, what if you just use it as like a cheap way to get long? Like you're holding if you're doing the 6-7 on Friday, putting it on till expiration, and if you don't get anywhere near your tenths, you've basically got like a cheap long for the Friday like lotto ticket. Like, what are your thoughts on just looking at it that way as a cheap way to get long if you don't have the big move?
Yeah, so it's always a trade-off, and from my test, you're better off just holding along at the start. So, like, why trade something that doesn't necessarily make money and could not protect you, that has a cost into it, than just buying it? And my theory on why calendars don't work is it's the perfect kryptonite to mechanical backtesters. Because if you think about it, like, you have to curve fit days to trade a calendar. You're automatically scoped to a small amount of data because most of them can only be set from 2022 to 2020. You usually only enter one time a day because you don't tranche. So you're automatically time curve fitting. And then you're using a profit taker or stop loss that won't work overnight, but that's what your mechanics are saying. And just because it hasn't moved like that doesn't mean it can. And then you normally have a return profile that's a lot of small wins, and then eventually you get completely blown out. So the entire nature and theory behind that is just too curve fitting nature, because like if a 6-7 worked, why wouldn't a 5-7 work? Why wouldn't a 3-7 work? Why wouldn't a 2-3 work? And why wouldn't they work at 9:30 that work at noon? And why wouldn't they work at a 10% stop or whatever? Whereas if you look at selling a $2 put, a 70% stop to a 5x stop works, and it works without EMA or with EMA. So that is an example of, it's just the ultimate like elixir to be mechanical, but actually justify being mechanical to curve fit. So that's why I've given up, and I still can't explain to you how they work and why they work. It's like, they're not really short theta because gamma will beat you if it actually moves. And then it's like, they aren't really short Vega if it actually moves a lot, or if Vega gets crushed too much with the upside move. And then also it's like, if we're talking risk premium, I don't think it takes enough risk premium with it. And at its core, like, you're just playing an intra-week trend that you're curve fitting by time, and that you're curve fitting by day of the week. Like, that's kind of what you're doing with it. I do think you can do like backwardation spreads when ball gets higher or something like that, or longer duration calendars, because the cost to execute and a way to go up and down is better. But in the Warren Buffett thing, I've taken that and put it in the too hard pile, and I don't plan on looking at it again.
You may have sold me.
Yeah. I mean, if you have a small account, like, I understand people can't run long ball and do whatever. I think it's fine to throw 2% of your account in it or whatever. But yeah, it's a habit and trade that you will definitely grow out of. So I would recommend getting too into it. But when you catch the curve, it is fun because you make a lot of money real quick. Yeah.
100%. Appreciate it. Thank you.
Got two more for you, Mark.
Yeah.
The first is another just kind of a basic one. So I was just double checking some of the back tests, and I noticed discrepancies. For example, that Monday 2-4 calendar, the 7DT PCS, where the results are still positive expectancy, but it's a slightly different drawdown, a slightly different MAR. Do you know, is there been some update in the data?
I mean, Option Omega kind of changed like slippage stuff a little bit on assumptions, so that could be it. But also, at least in live testing, like, I don't even really like those back tests that much, because when you're choosing a 15 delta, the market moves a little bit. The market's a little wide comparative to 0DT on what the mid price is. So there's a lot of noise in actually trading those as well. But yeah, calendars is definitely now out of my forte experiment, not something I'm super interested in, or I think is super promising in short duration, at least.
Got it. All right. And yeah, so then the final thing, which I just couldn't figure out. So do you know when I say re-entry 1-1, you know the trade I'm talking about?
Yeah.
So what happened to that trade? So it's great from May 2nd, 2022 to April 25th, 2024. That's the back test in the video. But if you expand that to 2025, all of a sudden it goes from a max drawdown of 22.6. It's currently in like a 67% drawdown.
Yes.
What the hell happened there?
So first of all, it's like tough trade to depend on a back test because you're taking so many entries into play if your slippage is ever off or whatever. But a huge core of a trade like that with reentry is, I'm assuming that's one when you take off one side and you reenter, or you're constantly entering the condor.
Pardon, you cut out there?
Are you constantly entering the condor, or are you re-entering one side when you're re-entering a new condor and you're only taking off one side when it gets challenged?
Yeah, so you're re-entering when it hits the profit target or it hits the stop loss.
Yeah, so this is it's like recentering, but that cost becomes a lot more. And those are trades, if you look at the net leg curve, where it's like you didn't really have those really bad days that absolutely destroyed you, and then the really good days just like continually paid a huge amount. And I see a lot of people do delta on those trades too. So now they're saying, oh, high vol is overstated more, high IVR, we make money tasty trade wise. It's like that may have worked in the past time frame. But when I look at something like that, I just say data risk. This is a Achilles heel of back testing in the process, where when you're doing something that trades damn near every single day and has four legs and trades several times a day, you know, just by 5 cents different on slippage, you could be a millionaire or be broke. So that's like a really tough trade to kind of hang your hat on. Whereas basically everything I do is testing naked options at the same type of credit, so I can compare them all apples to apples.
So you would say that re-entry in general is a dangerous back test to do? Very
much so. Yeah. Like, why wouldn't you just tranche it like every 10 minutes? You know what I'm saying? Or I think I'd be willing to field that if you could show me a back test of reentry that was like really close to a tranche. Like if they were similar, I'd be willing to think about it. But if those deviate a lot, it's probably not the reentry thing. And if it is, it was probably just the certain days when it worked out really well.
Well, great, man. Thank you for answering all those questions.
Yeah.
Super informative. Appreciate it a lot. I think everybody else does and will too.
Sweet. Well, enjoy your guys' weekend.
Thanks, Mark.
Yeah.
Thanks for doing this.
Of course.